Welcome back to My Mind Mashups for another deep dive. This one's tailored just for you. Today, we're really getting into the weeds on the economic landscape for 2025.
Yeah, we're pulling from quite a few places, expert analyses, practical guides, even some psychology behind financial decisions.
Exactly. Think of it as your shortcut. Our mission is to pull out the most important stuff, help make sense of it all so you can navigate what's coming.
It's definitely complex, but looking at the core trends helps a clearer picture emerge.
For sure. And how those big global things connect to, your own wallet.
Absolutely.
Okay, so let's kick things off with the big picture. Global U.S. economy, what are the main things we're seeing? Inflation, growth.
Well, the global outlook for 2025 is a bit of a mixed bag, really. Forecasts put global GDP growth around 3.3%.
Okay, 3.3%.
Yeah, which sounds okay, but it's basically holding steady, not really bouncing back to pre-pandemic levels. And growth is uneven.
Got it.
The U.S. is projected around 2.2%, which is actually a bit slower than before. But then you look at the euro area, facing more headwinds, maybe 1.0% growth.
Yeah.
China's also slowing down, looking at maybe 4.4%.
Okay, so the U.S. seems a bit stronger than, say, Europe, but still slowing down. Doesn't sound like we're totally clear.
Not exactly. The U.S. is facing some increased chances of recession. Early estimates for Q1 2025 even suggested a potential contraction, maybe around medically 3.7%.
Wow. What's driving that risk? You mentioned tariffs earlier.
That's a key factor, yeah. Those new tariffs, like the 20% on Chinese goods, plus others on imports from Canada, Mexico, they tend to cause ripples.
Like retaliatory tariffs, supply chain issues.
Exactly. And there's a debate, some say it helps U.S. manufacturing. Others, like analysts at Morgan Stanley, think it could add maybe 0.5%, even a full percent to core PCE inflation.
Right, so prices go up just as the economy might be shrinking, that sounds like.
Stagflation. That's precisely the worry people are talking about.
Right.
With core PCE inflation around 2.8% and growth possibly faltering, yeah, it brings back those 1970s comparisons.
Are the official models showing that risk?
The New York Fed's model, for instance, puts the probability of a recession in the next year around 30%. So it's a notable risk.
Okay. But there's a counterpoint, right? The job market.
That's the area of surprising strength. Unemployment has stayed pretty low, around 3.8%.
Which props up spending, presumably.
It provides some underlying support, yes. Even though inflation has eaten into wage growth, a strong job market helps cushion things.
Okay, quite a complex picture. Strong jobs, but inflation and recession risks, stirred up by trade issues. Let's zoom in a bit. Equities, the stock market. We keep hearing about the Magnificent Seven.
Yeah, it's hard not to hear about them. Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, Tesla. Their influence has been huge.
How huge?
In 2024, they accounted for over half the S&P 500's returns. But they're less than a third of the index's total value.
That sounds concentrated.
It definitely raises eyebrows. Some experts compare to the dot-com era, warning about a potential correction if there's a macroeconomic shock.
Because if the economy stumbles, these high-flying stocks might fall hardest.
That's the thinking. A lot of optimism, especially around AI, is baked in. So yeah, diversification seems wise. Don't put all your eggs in that one very large basket.
Got it. What about real estate? Another complex area.
Definitely seeing a split there, especially in commercial real estate. Prime properties, modern offices with good amenities, they're seeing a bit of a rebound. Vacancy rates dropping.
But not all commercial property.
No, the older, maybe suburban office parks, they're still struggling with higher vacancies. Retail, surprisingly, is holding up fairly well, maybe due to experiential retail and shifts to the Sun Belt.
Okay, and industrial.
Stabilizing after its pandemic boom.
Oh,
But the big story is residential.
because of mortgage rates.
Exactly. Rates around 7.1% are just a major hurdle. It's creating gridlock. Homeowners with older, much lower rates are essentially locked in. They don't want to sell and take on a 7% mortgage.
Which means fewer houses on the market.
Right. Keep supply tight, prices relatively stable, but makes it really tough for new buyers.
Yeah, those rates have a huge ripple effect. Okay, last market snapshot. Crypto. Always volatile.
And 2025 is no exception. Bitcoin saw a big drop early in the year after those tariff announcements, though it's found some stability since.
Is institutional interest still growing, like with the ETFs?
Yes, we are seeing continued inflows into Bitcoin ETFs, which suggests larger players are still engaging, but the regulation,
Yeah.
it's still all over the place globally.
Uneven.
Very. And stablecoins are becoming more important for just, making transactions within the crypto world. Plus, central banks are actively looking into their own digital currencies, CBDCs.
Okay, that's a great overview of the macro climate and key markets. Now let's pivot. Let's talk about our own financial toolkits. Financial literacy, what does that really mean?
It's so much more than just balancing a checkbook, isn't it? It's really the whole package, the skills, the knowledge, the behaviors you need to navigate finances effectively, make informed decisions.
So not just knowing terms, but applying them.
Exactly.
Mhm.
The OECD puts it nicely, having the capacity for effective decisions across a range of financial contexts to improve well-being and participate in the economy. It's about applying concepts like compound interest to make choices that secure your future.
And does it actually make a difference for individuals, for the economy?
Oh, absolutely. On both levels. For individuals, research consistently shows more financially literate households are way more resilient during shocks.
Like the 2008 crisis.
Yeah, or the pandemic. They were more likely to have emergency savings, less likely to face foreclosure, better able to use options like payment deferrals.
And for the wider economy.
Countries with higher financial literacy tend to see faster GDP growth,
Mhm.
probably because people feel more confident starting businesses, participating in capital markets. Lack of literacy, conversely, can really drag things down through poor debt management, bad investment choices.
Pretty compelling reasons to boost our own literacy. Are there common myths holding people back?
Oh, definitely. Several big ones, like all debt is bad.
Which isn't always true, right?
Not at all. High interest debt, sure, that's damaging. But strategic debt, like a mortgage to build equity or a business loan that generates income, that can be a tool.
Okay, what else?
The idea you need to be wealthy to invest, totally untrue now with robo-advisors, fractional shares, you can start small.
Mhm.
Or that renting is throwing money away. Sometimes in high-cost areas, renting and investing the difference makes more sense.
Right, it depends on the numbers.
Exactly. And the myth that carrying a credit card balance helps your score, it doesn't. High utilization hurts your score.
Good to bust those myths. They can really block people. So if we want to take control, we're step one, budgeting.
Budgeting is absolutely the cornerstone. It's about knowing where your money is going, then making it go where you want it to go.
Yeah.
Aligning spending with goals.
Are there simple ways to start?
Yeah, several good ones.
Mm.
The 50-30-20 rule is a popular framework. 50% of after-tax income for needs, 30% for wants, 20% for savings and debt paydown.
Simple enough.
Or the envelope system, physically putting cash in envelopes for different categories. When it's empty, you stop spending in that category.
Old school, but effective. And there are apps now too, right?
Loads of great apps. They automate tracking. Rocket Money, YNAB. You need a budget, Pocket Guard, Good Budget. They make it much easier.
How do they help specifically?
They track spending automatically, categorize it, send alerts if you're over budget, track net worth. Some even help negotiate bills. Really useful tools.
So find a method or app that works for you. Once the budget's set, how do you manage expenses ongoing?
It starts with tracking everything consistently. Use an app, a spreadsheet, whatever works,
Even small stuff.
especially the small stuff that adds up. Then, after a few months, analyze those patterns. Where are the leaks? Unused subscriptions? Too much dining out?
Find the surprises.
Exactly. Then review regularly and adjust. And automating bill payments is key. Avoids late fees, ensures essentials are covered.
Okay, budget, expense tracking. Now let's tackle debt. It's a big challenge for many. Strategies.
Two main popular methods: snowball and avalanche.
Snowball first.
Snowball means paying off the smallest debts first, regardless of interest rate. Gets you quick wins, builds momentum, psychologically helpful.
Feels good to knock one out.
Right. Avalanche prioritizes the highest interest rates first. Takes maybe longer to see the first debt disappear, but saves you the most money on interest overall.
So psychological win versus mathematical optimum.
Pretty much. Choice depends on what motivates you.
And building good credit alongside that. What's key?
Payment history is number one. Biggest chunk of your score. Set up auto pay for everything. Never miss a due date.
Crucial.
Then credit utilization, how much credit you're using versus your limit. Keep it low, ideally below 30%.
Not maxing out cards.
Definitely not. Also helps to have a mix of credit types cards, loans, and a longer credit history. And stay away from things like payday loans, high interest traps.
Really important warnings. Okay, shifting gears slightly, but related. Investing. Essential for long-term wealth, but daunting for beginners. Basics.
Yeah, let's demystify it.
Yeah.
Core asset classes, stocks, ownership in companies, bonds, loans to governments or companies, and ETFs, exchange-traded funds.
ETFs are like baskets of stocks or bonds?
Yeah, exactly. They trade like stocks but give you instant diversification. Super useful for beginners.
And retirement accounts. 401k, IRAs.
401ks are usually through work, often with matching contributions, free money. Contributions are typically pre-tax. IRAs you open yourself. Traditional IRAs can give you a tax deduction now, grow tax deferred. Roth IRAs use after-tax money, but qualified withdrawals in retirement are tax-free.
Lots of options there. What about real estate investing if you can't buy a whole property?
REITs, real estate investment trusts, are a good way. They trade like stocks but invest in real estate. Or crowdfunding platforms let you pool money with others. More accessible entry points.
And back to those myths. Investing isn't just gambling, right? And you don't need a fortune.
Absolutely not gambling if done thoughtfully. And no, you don't need vast sums. Consistent, even small investments over time can grow significantly. That's the power of compounding.
Very reassuring. Okay, last big topic. Emergency and opportunity funds. Why are these so crucial?
They serve different but equally vital roles. An emergency fund is your safety net for unexpected expenses, job loss.
How much should be in there?
General rule of thumb is 3 to 9 months worth of essential living expenses. Depends on your job security, dependents, etc. Keep it somewhere safe and easily accessible.
Like a high-yield savings account.
Exactly. Then there's the opportunity fund.
Which is for
seizing opportunities. Time-sensitive investments, maybe a course for career advancement, things that could improve your situation but need ready cash.
So one protects against downsides, the other helps capture upsides.
Precisely. Build the emergency fund first, maybe start small, aim for $1,000, then build towards the 3-9 months. Opportunity fund size depends more on your goals and risk tolerance.
And it's not an excuse for random spending.
Definitely not. Both need purpose. Having both gives you security and flexibility, resilience and growth potential.
This has been incredibly comprehensive. We've gone from global GDP forecasts right down to the nuts and bolts of budgeting apps and savings goals.
It really shows how interconnected it all is, doesn't it? Understanding the big picture helps you make smarter personal choices, and taking those personal steps builds resilience for whatever the economy throws at us.
Absolutely. So for everyone listening, we really hope you'll take a moment to think about what stood out. What's one thing you heard today that you could maybe start implementing?
Maybe it's checking out YNA or Rocket Money. Maybe it's looking at the snowball versus avalanche method for your debt. Or just starting that emergency fund with a small automatic transfer.
Remember, it's about progress, not perfection. Building financial well-being is a journey.
And maybe that leads to a good question to ponder. Reflecting on all this, what area of your financial life feels most pressing right now? And what's one small, concrete step you can commit to taking this week?
We really hope this deep dive has given you some clarity, maybe some motivation. We genuinely love to hear what resonated or any questions you have for future deep dives. Feel free to share your thoughts.
Please do.
And of course, if you found this valuable and want more explorations like this, please do like, share, and subscribe, or follow my Mind MashUps. We're on Amazon Music, Audible, Facebook, Pocket Casts, Spotify, and YouTube.
Your support really does help us keep creating this content.
It really does. Thanks so much for joining us today, and we're already looking forward to our next deep dive together.